This is the Friday, March 31st, 2017 version of the Market Plus segment. Joining us now are Naomi Bloom, a market advisor for Stuart Peterson, Elaine Cubb, an analyst and author of the book Mastering the Grain Markets, Darren Newsom, DTN's senior market analyst, and Don Rose, the founder of U.S. Commodities. Welcome back to all of you.
Thank you.
Elaine, when we ended the show, you left us on a great segue talking about the dollar. We've seen that strength. We've seen the Fed raise rates once. Where does it go from here?
It should, I think, remain strong. The fundamental justification behind the strength in the dollar that came about leading into January is still there, that we have slow, steady growth in the economy. The consumer indexes that came out today were very slightly up, but they're upwards, like 0.1%, right?
Okay.
The economy is growing, prices are rising, there is a slight amount of inflation in the economy, so interest rate rises are likely to occur twice more in 2017.
And earlier this week, consumer confidence was printed at a 16-year high. Does that have any bearing on this market? Don?
Well, I think when you look at, the consumer confidence is on the rise. And I think the other thing, when you look at the dollar, we're the best of the worst if you really look around. Our interest rates are rising, and at the same time, the rest of the world is still struggling. So, I think the dollar, does stay strong, probably continues to rally. But at the same time, that's not particularly positive for the exports, which we really are going to have to struggle with from a competition standpoint.
All right. Darren, anything from a technical perspective? Is the dollar doing anything fun?
Well, what's interesting is that Elaine and Don are absolutely right about the fundamentals. The dollar should be strong. It remains the least ugly dog in the show. But from a technical point of view, on the long-term monthly chart, dollar actually looks like it's established a long-term downtrend. So what fundamental justification for there? There isn't any right now. But if you just throw away the title of the chart and you just look at it, it seems to have established a top. If it comes down, at the same time, gold has established a longer-term uptrend, and the euro has actually tried to establish an uptrend. So none of it fits together fundamentally, but from a technical point of view, it looks like we are in for a bit of a change in the direction of some of these key financial markets.
All right. Naomi, do you have any thoughts on the dollar as we look out through the rest of this year?
I hope it crashes.
Right?
Yeah, right.
How far down does the dollar need to go for us to get really competitive?
We have been competitive. If you look at what corn exports have done, it's remarkable how strong our exports are considering the value and the strength of the dollar. So awesome, let it fall.
Okay. We've got a question here from one of our Twitter followers. This is from Steve. He's on Twitter at blackandbluebird9. He's asking, is there a major currency that has the potential to make new lows in the near future? And he's asking, is it the Chinese renminbi?
Whatever
the yuan.
the Chinese that is.
Yes.
Except for maybe the dollar making new lows. If we're looking at overseas, I still think ruble's pretty weak. It's bounced up a little bit here, but to me, it's still one of the weaker, currencies. China's currency is fairly weak. I'm not even going to try to pronounce it. And then you always have to wonder about the real with all the problems that Brazil's having. It's seen a bounce off of its multi-year lows here over the last number of months, but is it going to be able to hold? I don't know. I'm not convinced. So if we look at that, some of our key competitors, in wheat with the ruble, and soybeans and corn with the real, we could be looking at some competitors with some weak currencies here down the road.
Okay. All right, some additional headwinds facing us. Now, we have a pile of Twitter questions, so I want to get to them. But before I do, we did not get a chance to discuss the cotton market. And one of the things, well, first let's talk quarterly stocks. How did they end up on the week or on the report?
I didn't see the quarterly stocks. I'll just be honest.
cotton.
No, I didn't. I saw that the acres were up, almost a million
well,
acres.
Let's talk acres. Let's talk acres.
Yeah.
Yes. So, Naomi, as you mentioned, acres are up a little bit north at 12 million projected,
Yes.
correct?
Yes.
Where does that put us to this year? Up a million?
It's almost a million. Almost
Okay.
a million more than last year.
Cotton acres coming out of beans or coming out of, corn, I suppose.
Yes, and sorghum.
Okay.
Yeah.
Is what I had been hearing. And actually talking about rice a little bit earlier, rice a little bit also is where they would be kind of switching things over if they could, but I mean, some of those rice fields are pretty established. But cotton had its rally on the anticipation of needing the more acres, and so actually it has a rounded top and it's been working a little bit lower.
Okay. You expect to see it work to the downside. Elaine, when you look at the cotton market, is that kind of what your thought is?
Yeah, I'm not super bullish on cotton, and I was just going to say geographically, yeah, it was Texas, and so yeah, you're coming out of corn acres. This is not a Texas story, but barley was down, oats was down as far as acreage. A lot of these specialty crops did lose, so cotton was unique in being a winner of acres.
Don, as you look at the cotton market, how aggressive do you want to be marketing post-report?
Well,
on new crop cotton.
Yeah, I think cotton's like a lot of things. We were up 21% on the acres, it's over 12 million acres. So, more acres out here. Really the producer's just trying to run to a crop that he thinks is profitable. Someplace said he has some traction on it. But, I think it's the demand side that we really have to worry about in a lot of these markets. And I think cotton's the same one. We'll see, China and Vietnam maybe a little bit slow on their import pace. So I think that's the real problem.
Okay. Darren, any thoughts on cotton?
Yeah, just, I would keep it brief, but, if we watch what the cotton market's done here, the futures market's rallied. We had non-commercial money piling into cotton. Meanwhile, the future spreads were trending down. So you've got the rubber band principle going on in here where you can't stretch it that much further. Looks like it's getting ready to snap and the market's going to come back to its fundamentals, which means a more bearish situation.
All right. Our next question is from Aaron in Syracuse, Indiana. He's on Twitter at Aaron Bobeck. Thank you, Aaron. He wants to know, and we've discussed this on the program, but I want to know what in your mind is the market that most exemplifies this question. He says, are we going to see any significant price movement on planting weather and long-term forecasts? Naomi, you mentioned corn market was perhaps the most bullish. Is that something you really believe?
Yes, on summer weather, but
Okay.
not planting weather. We all know we can get the crop planted these days, so
Okay.
we don't get the planting scare rallies anymore, but I'm looking for the summer one.
Is there any commodity out there that planting weather could really have an impact, or are we all watching for this summer and we're needing heat and dry to really move this complex to the upside?
Well, no, I think when you look at it that you have to really say, you're the 1st of April, you're moving in the first week of April, and I do think it's a critical time for producers. They're going to watch very closely. If we're not at an ideal situation on planting corn, I think you'll see those acres change. So I think it's right now, this next week, you're going to have to watch it. You have to remember that historically, acres do rally or do move up about almost a million acres from the March report to the June report. So I think next week's going to start to be critical, and I think that's part of the reason on Friday we added a little risk premium to the market. So I think we're watching it now.
Gotcha. Our next question is from Phil in Ontario, Canada. Phil is asking, with what we've all talked about, with corn demand projected at 14.6 billion bushels, soybean demand at 4.1 billion bushels, can it continue? Elaine, is there room out there for additional demand on corn and soybeans, given what we saw in this quarterly stocks?
I think globally we could make the argument that the story that has sustained these record demand paces for feed grains in general, that story is still in place. So if we can continue to find export markets or find non-domestic markets somehow to build new places for it to go, then demand could continue to rise. But we're pretty well played out, I think, in the United States as far as what we can use.
Right. Darren, thoughts on demand, Mr. Sunshine over there?
Yeah. I think you're going to have to be a little bit concerned about demand in here. Again, corn demand was extraordinary because Brazil didn't have anything. Now Brazil's going to have 2 big crops, and they're going to have a cheap currency. A lot of countries are going to be looking at that. The other side of the coin is there's always right now, just talk and threats to possible trade agreements that if these threats ever become action, all of a sudden U.S. demand isn't going to look quite so burly. It's going to look a little bit weaker.
Right.
So we have to, certainly that's still a threat out there.
Okay. It's tough to sell grain to people who aren't allowed to buy it for whatever reason. Our next question, and this one, I'm interested to hear your thoughts. Glenn in Bryan, Ohio, Glenn Newcomer on Twitter is asking, what is the best short-term option strategy a producer should consider from now until July? And let's talk beans off the top. Naomi, any option strategy really got you excited to get us through that first part of our planting weather, I suppose?
Well, you could take this question 5 different ways. Are you looking to try to take advantage of a market going higher or a market going lower. So maybe it's an open-ended question.
Yes, I think he is growing crops and wants to know, how do I not lose money so I can see my banker and have him not fire me? What's our best way to guarantee or at least ensure that we're protected here?
Well, a strategy might be, and I don't know that it's my number one, but I'm just trying to think off the cuff here. If you were thinking that the market might be in a little bit of a range for the next few months, yet you're worried about protecting to the downside, you could, if you have no risk tolerance, you could buy a November 960 put and sell under it an 860 put. That way, if the market goes sideways to lower, you have protection, you don't have margin calls. If you have a little bit of a margin risk, you could buy the 960 put, sell an 860 put under it, and then you could sell a call above it. But then, of course, you're subject to margin call if the market should rally. I would switch gears and go to corn and start selling puts in corn. That's what I would do.
Okay. What strike price would you use selling puts in corn?
I would have to look to see where things finished out. I've been traveling a lot, but like a D's 350 put, I would say, would be a good one to be selling.
Yeah, D's closed today at 388, but I don't know where the price is.
Well, I would give yourself room. I'm conservative that way.
Yeah,
Mike,
Don?
I think, if a producer's really trying to give him a chance to really hit a home run, give yourself a lot of different directions, I would prefer that they'd go in and buy September 370 corn calls. They're already worth, some money, and I would sell a D's 470 call against as a premium contract. I think it gives you a lot of variation. If the market rallies, you can sell cash against it. You can get out of the call. You can have a premium contract on, but give yourself a real chance.
All right. Yes, Darren?
Yeah. I would probably look at it a little bit differently. I'm not overly crazy about selling options in here because the volatility is so low. We've seen it just erode. So this is an opportunity to buy some, and Don's strategy of going out to the September is a pretty good strategy. You can buy some time with the lower volatility. The problem is September acts a little squirrely, doesn't know if it's old, doesn't know if it's new. You could also look at going into short-dated new crop July options, which is based off the December contract, down here with the market showing it might be trying to turn around on both its daily and weekly charts. Lasts up through July, which would through the end of June, which would catch the seasonal rally. Low volatility might not be a bad opportunity. If you've done some forward contracting, this would, if you've done some selling, buy a call back against it. Some of these short-dated new crop calls back against it, low volatility, might work out.
All right. Elaine, turning to you, we've got a question here from Mike in Southeast Wisconsin. He's on Twitter at Crane Grain. He wants to know, what are your thoughts looking farther out into the future? December 18 corn at $3.95 plus. Does a grower sell a third?
Not a third.
Okay.
No, not a third. I mean, we talk about weather. Going that far out, you do sort of expect to see some sort of weather, something happen somewhere in the universe, right? Like, it is, the thought is that there could be an El Nino year coming up, and El Nino may not affect U.S. grains, but it could affect palm oil. It could affect lots of commodities. It could bring in a burst of bullishness. So between now and then, I wouldn't be selling a third, and I wouldn't sell anything at $3.95, honestly. I think that we could aim higher than that.
All right. And Naomi, I'm guessing you'd probably agree, hold on, don't be marketing too aggressive.
And I'm waiting for Elaine to call the high like she did last year.
Yes, because Elaine, to her credit, she called the high in the corn market, not just in the week or the month, to the day, the 449 peak. Elaine Cub called it. What's the date we should be watching for this year, Elaine?
June 18th. So it was based on statistical expectation of seasonally, what is the date with the highest probability of seeing the December corn contract hit its annual high. And it turned out to be the middle of June, because that's when we do tend to have the most weather risk in the market. So it was June 18th last year. Because it hit there on the same date again, the statistical expectation is the same this year. So our best chances of seeing a high statistically is the middle of June, but it could be any time in here. I mean, I think we need to be spreading out our sales all through that spring time frame to get a good shot at it.
All right, we did not get a question, but I have a question for Don Rose. Cows come down pretty substantially over the past 2 years in their price at the sale barn. Is it done? Is this the time to get in there and start buying? Where are we in the cattle cycle?
Well, and you mentioned the cattle. The cows peaked out at about $2,200, and right now they're about $1,200 for a cow. But the cattle cycle, we bottomed at 11-13. You know, we topped out in prices at the year 14-15. And so we're really probably going to bottom out somewhere in the year 2019-20. So I think we're sliding to the low end of the range again, but before we really bottom and start to move up, it's going to be a little while yet. But the cow-calf operator is the one that probably has sees the tightest margins.
Looking out to the future, they're the ones that haven't lost their pound of flesh,
Exactly.
so to speak. Well, with that, I want to thank our entire panel for taking the time to come down and help digest these reports and shed some light onto the markets. Thank you, guys.
Thank you.
Join us again next week as we look at how one-stop shopping is connecting growers and buyers. So until then, thanks for watching or listening. I'm Mike Pearson. Have a great week.